Let's talk about one of the biggest shifts happening in digital finance today. Stablecoins have been around for years, serving as the go-to bridge between crypto and fiat. But in 2025, we're seeing a major pivot. Institutions are moving toward asset-backed stablecoins, a model where real-world assets like US Treasuries or gold are tokenized and used to support digital currencies. It's not just a technical upgrade, it's a rethinking of how stability, transparency, and compliance can work in the digital economy. From fiat pegs to real-world value. Historically, stablecoins like USDT and USDC were pegged to fiat and backed by reserves that users mostly had to trust, but couldn't always verify. Concerns over reserve transparency, audit frequency, and counterparty risk, those were growing louder. Enter tokenized, real-world assets. We're now seeing stablecoins backed not just by dollars in a bank, but by short-term treasuries, commodities, and other tangible assets that can be audited, tracked, and verified on-chain. Projects like Ondo Finance's USDY and Franklin Templeton's BENJI are leading the way, linking each token to US Treasury instruments. As of mid-2025, the market for tokenized treasuries has already surpassed $1.6 billion in value, according to data from RWA.XYZ. That's not hype, that's demand. Why institutions are leaning in? So, what's driving this shift? Three things: risk management, regulation, and yield. Traditional fiat-backed stablecoins served a purpose, but for regulated entities, they weren't always a fit. Now, with new policies like the Genius Act mandating real-time audits and 100% reserve transparency, asset-backed stablecoins are checking all the right boxes. They're compliant, auditable, and backed by real financial instruments. Digital asset consulting firms, including ours at Kenson, are seeing a spike in institutional interest. For asset managers, fintechs, and treasury teams, these new stablecoins offer instant settlement, improved visibility, and reduced exposure to banking counterparty risk, all while aligning with evolving regulations. Beyond treasuries, tokenized gold and commodities. It's not just about bonds. Gold-backed stablecoins are also gaining traction, offering a new way to diversify and hedge currency risk. Tokens like PAXG from Paxos and Tether Gold XAUT are backed by physical gold, combining the scarcity of a traditional store of value with the flexibility of digital finance. While these commodity-backed options aren't yet as widely adopted as treasury-backed coins, they're becoming part of the institutional toolbox, especially for those exploring altcoin hedging or inflation-resistant assets. The challenges still matter. Of course, no solution is without trade-offs. Custodial centralization is a key concern. Who holds the underlying assets, and can that trust be verified? Then there are smart contract risks and fragmented liquidity across multiple blockchains. That's where smart consulting and due diligence come in. Asset-backed stablecoins aren't just a new asset class. They're a signal that digital finance is maturing, moving beyond speculative hype into something more grounded, regulated, and strategically useful. For institutions, this isn't just about faster payments. It's about building an infrastructure where transparency, compliance, and capital efficiency can coexist, and it's already happening. Your guide to the new digital economy. At Kenson Investments, we offer research-driven insights and digital asset consulting to help institutions stay ahead of the curve. Whether you're exploring tokenized treasuries, diversifying with commodity-backed assets, or building a compliant crypto strategy, we are here to help. Subscribe to our insights or connect with us directly to explore how asset-backed stablecoins and the broader world of tokenized finance can align with your strategy. Because in today's digital economy, smart moves start with smart questions. Visit kensoninvestments.com to learn more.